Good morning, everybody. Welcome to today's webinar for the launch of the TAMIM Global Infrastructure Fund, something that we've been looking forward to over the last couple of months and really excited to be presenting to everybody today. Before we get into today's presentation, just a few housekeeping points that I wanted to run through. We had originally scheduled to have Rob Swift with us on today's webinar. Unfortunately, he got delayed coming out of Europe where he's currently on a research trip. So we're going to be joined by Charles Wannon, who is the co-portfolio manager for the Global Infrastructure Fund based out of Hong Kong. So really looking forward to hearing what Charles has to talk to us about today. A few other items to cover off. As per usual, we are really interested in your questions and comments as we go through the presentation today. So if you look at the bottom of your screen or potentially even the top of your screen, you should be able to see a Q&A button. And if you click on that, please just type in your questions and we'll endeavor to get around to everybody's questions at the back end of today's presentation. If we don't manage to get through all the questions today, the presentation is being recorded, and when we send out the presentation recording to all the attendees, we'll send out the answers to any questions that remained unanswered. As you can see on your screen now, just the regular disclaimer, pretty small, and I'm not going to expect everybody to read through that today, but essentially what it says is that today's presentation is general in nature and it is not intended to be specific to your personal requirements and needs. So please just take everything that we're talking about today as general advice only and not specific advice. So heading across into today's presentation, before we start talking about the Global Infrastructure Fund, just a quick reminder of TAMIM. We're a boutique investment management business based out of Sydney, and we manage around about $250 million on behalf of close to 500 investors across our strategies. We operate across equities, property, and credit. And within the equity segment, we run both Australian and global equities. On the Australian equity side, we have the Australian All Cap and Small Cap Income Funds, both of which have done exceptionally well under the guidance of portfolio manager Ron Shamgar. The Australian All Cap portfolio, which is our flagship Australian equity portfolio, annualizing between 16 to 17% over the last 5 years. On a global perspective, we run both the Global High Conviction and the Global Technology portfolios. Global High Conviction ably run by Robert Swift and his team at Delft Partners, who also run the Global Infrastructure Fund, and the Global Infrastructure Fund will slot nicely into that segment. From a property perspective, we run single asset properties. We tend to be quite contrarian in our view around property. We like to buy things that people are moving away from at that particular time. Certainly 7 years ago, we were buying retail properties. Today, we're selling them back to people who are telling us we were crazy to buy them. And today, we're actually in the process of picking up additional office assets. We've just purchased 2 over the last 3 years. And finally, from a product or solution perspective, we run the TAMIM Credit Fund as well, which is a portfolio which invests into a underlying group of private debt investments, and at present is annualizing just over 7.5%. Over the 6.5 years now that portfolio has run, it's only ever had one negative month. So enough about the TAMIM investment platform. Just moving across to today's presentation. Before I introduce Charles, I just wanted to talk a little bit about the global infrastructure strategy, which has been running now offshore for about 8.5 years and in Australia over the last 6 years for a number of our select clients. With the current environment, and Charles will talk a lot more about this in today's presentation, we think it's the perfect time for this to be made available to our broader group of clients, and we're quite excited by what we're seeing in the space. Over the 8.5 years offshore and the 6 years onshore, the portfolio has delivered very close to 13% annualized returns for clients, and done so in an environment where you've seen the return stream display very low levels of volatility, which certainly in a superannuation or a portfolio which is heading towards retirement makes a lot of sense in our view. Having said all of that, before I hand across to Charles, just wanted to introduce him. He is the co-portfolio manager for the global listed infrastructure portfolio and also the co-manager of the Asian equity strategy portfolio out of Hong Kong. Charles is responsible for all aspects of the day-to-day investment management process, all the way from screening and idea generation to trading and portfolio management on global infrastructure. Prior to managing the global infrastructure portfolio, Charles was at IQEQ, where he headed up the business analysis and AML teams, and was also responsible for training and new projects at the firm. He is an Australian native, graduated from Bond University. And having said all of that, Charles, I'd like to introduce you, or welcome you, I should say, to today's presentation. Look forward to hearing what you have to say. Charles.
Thanks, Darren. Can everyone hear me? Or I hope everyone can hear me.
I can hear you loud and clear.
So good morning, everyone, and thank you for joining. As Darren said, my name's Charles Wadden, and I'm the co-portfolio manager of the global listed infrastructure strategy with Robert Swift. Robert sends his apologies. He would have loved to be here, but he's been held up. So we'll just crack on without him. Listed infrastructure is an asset class that we've been investing in since December 2016. It's been run both in Sydney as a managed account and in Hong Kong. And we've had some pretty good success over that time period. So I'll just jump into a quick agenda slide about what I'm planning to talk today. So firstly, we'll look into why we think listed infrastructure is an important asset class. Then we'll have a look at why active management is the best way to play the space. And finally, why us, essentially, why our strategy is the best way to invest in the space. All right. Okay, so why listed infrastructure? Firstly, we should probably address what is infrastructure, or what do we define as infrastructure? So we define infrastructure broadly as businesses that own, develop, manage, and operate an economy's capital stock. So more specifically, the segments that we include in our universe are utilities, oil and gas, storage, and transportation. So that includes things like oil and gas pipelines, LNG plants, that type of thing. Infrastructure, construction, engineering, transportation, including things like ports, railroads, airports, and highways, healthcare facilities, telcos, and we also look at some infrastructure REITs, such as data centers and cell towers. Essentially, the strategy invests in the core physical assets that drive the well-being of the global economy. So infrastructure investment, from a government perspective, had been neglected for a significant period of time by our governments. So this prolonged period of underinvestment in developed economies, particularly, has created opportunities for private participation in the sector. So if you look across to the US as a good example of this, so the American Society of Civil Engineers publishes a report every 4 years called the Infrastructure Scorecard. And what they say in that report is that even following the two landmark infrastructure bills that were introduced by the Biden administration, which was the Inflation Reduction Act and the Infrastructure and Jobs Act, the spending gap on what is required for US infrastructure still sits at around $3 trillion US. The companies in the space have a really good track record of paying high dividend yields. In addition to this, many of the companies have contracted revenues that are indexed to CPI. So this provides an inflation protection factor to the companies. These businesses tend to be either natural or regulated monopolies that have very large upfront investments, and that creates a really high barrier to entry for new entrants. Uh, Historically, the companies in the space have exhibited a much lower volatility to global equities, and this stems from stable cash flows and more predictable revenue growth. And finally, on this slide, having a comparison between the listed space and the unlisted space, we found that listed infrastructure has exhibited comparable returns to the unlisted space, and it has the added benefit of liquidity. Exiting from a private investment can be a multi-year exercise, but we offer the benefit of liquidity within our portfolio. Moving on to the global investment needs. So the G20 and the World Bank have an initiative called the Global Infrastructure Outlook. And this was created to estimate the global investment needs for infrastructure before 2040. This report was first produced in 2018, and the figure for the global investment needs before 2040 stood at 94 trillion US dollars. And if we move that forward today, that number is a significant understatement, and that number would probably sit somewhere over the 100 trillion US dollars in what needs to be invested in infrastructure before 2040. So the bulk of investment is going to be likely, or will be made rather, by government or in some sort of government private partnership, public-private partnership. Now, there's significant incentives for government to involve themselves in infrastructure investing. As compared to other government spending, we see the multiplier effect of spending in infrastructure is significantly higher. And if you think about it, this makes sense because most government spending tends to be on services that are consumed now, whereas infrastructure investment continues to benefit the economy for many years into the future. Okay, so looking at the inflation and downside protection elements of the infrastructure space, the chart on the left shows the year-on-year cash flow growth, and we have an infrastructure index versus the MSCI World. The infrastructure index is the blue, MSCI World, so global equities is the orange. And as you can see, over a prolonged period of time, the cash flow growth year on year for infrastructure has exceeded the MSCI average. You can also see from this chart that the volatility of cash flow growth year on year is significantly lower than that of global equities. The opportunity set that we look at is broadly diversified amongst energy, infrastructure, electric generation, transportation, communications, healthcare, and construction engineering. All of these segments have different economic drivers, and they perform at different times in the market, which allows us to gain the benefits of diversification. Okay, so looking at the listed infrastructure space more broadly, so currently it is a deep and growing asset class. So there's around 155 billion US dollars currently actively managed, and the combined market capitalization of the companies that we look at within our universe is over $5 trillion. Just looking at the chart on the right, comparing listed infrastructure index versus private infrastructure, you can see that the shaded red band is the range or the potential range for private infrastructure, and the blue line is a listed infrastructure index, and you can see that it performs around the midpoint over a prolonged period of time. And as I mentioned, it has the benefits of liquidity and diversification. So just looking into some of the major themes that we are investing in at the moment. So firstly, I'll address probably the most important theme at the moment, which is the AI revolution. And what we found is that AI trends have really shifted away from the semiconductor supply chain and moved upstream to things like data centers, power grids, and utilities. And many of the established infrastructure players around the world have been well placed to benefit from this tailwind. The other major trend that we've been looking at for some time now is decarbonisation. So, in the same way of energy consumption for AI, utilities and contractors are at the forefront of decarbonisation trends, and we think will play a significant role in the future. Despite movements against decarbonisation, particularly in, I guess, the last 2 years, we see this trend amongst certainly developed countries to continue, and they'll continue to decarbonise their economies towards 2050. Finally, for this slide, urbanisation and demographic shifts. So we see the trend of urbanisation to continue, particularly in emerging markets, and this drives a demand for transportation, utilities, and communication infrastructure. As cities develop, we see more demand for things like mass transit or improved internet infrastructure, and that will create more economic efficiency for those cities. Even if you look at a city like Sydney, the metro, which has come in the past few years, has significantly improved travel times, and it's also opened up more corridors within the city, and this creates more efficient land use. Okay, so we'll drill down a little bit on one of the themes that's particularly popular at the moment. In fact, I think it's probably the most significant development in certainly the utility space, but probably the listed infrastructure or the infrastructure space more broadly, and it has been for some time. So the mass adoption of AI in the past year has really transformed the energy demand landscape. So globally, data center energy consumption is expected to double, reaching over 1,000 terawatt hours by 2026. And this is primarily going to be driven by AI, but also crypto mining. If we put this in an Australian perspective, Australian electricity consumption, I believe, totaled around 270 terawatts last year. So by 2026, the global data center electricity consumption will be about 4 times what Australia currently consumes. We're already seeing trends like this occur in Ireland. Similarly, in 2026, data centers will consume about 32% of national power in Ireland, and that's up from 17% in 2022. We think that the bulk of data center construction is probably going to occur in the US, but we see opportunities for friendly energy jurisdictions, particularly those served by natural gas infrastructure. And we think that those areas will probably take advantage. Looking a little closer to home into Asia, Singapore, where a lot of tech infrastructure has been based, banned the construction of new data centers in 2019. This ultimately led to Johor, just over the border in Malaysia, being the major beneficiary of a rapid data center build out. If we look forward or fast forward to 2035, estimates for Malaysia power usage showed that a staggering 40% of peninsular Malaysia will be consumed by data center energy. Japan also represents what we think is a very interesting opportunity. Recently, you may have seen in the news that Japan has prioritized a restart of their existing operable nuclear reactors. So up to 24 gigawatts of nuclear capacity is still offline following Fukushima, and just putting that capacity into an Australian context again, 24 gigawatts generates around 200 terawatt hours. So that's around 75% of Australia's total energy consumption in 2024 is just sitting dormant, but operable in Japan. So moving on, why we think active management is really the only way to play in this space. So if you look at a lot of the passive indices from the major providers that focus on global infrastructure, they tend to reflect a really rigid rules-based approach that is often a relatively narrow definition of infrastructure, and they also have a very limited rebalancing frequency. Active management allows us to have constant and proactive risk monitoring and managing in response to changing macro and market conditions, along with some real-time evolution of the infrastructure sector. What we find is themes emerge within the space that aren't initially captured by passive indices until massive capital appreciation has occurred. So I spoke earlier about, or in the last slide rather, about demand for nuclear energy from data centers and AI. The significant beneficiaries of these moves were either not present in major indices or represented a small weight until 2024, when the majority of capital appreciation had occurred. If you look at the chart on the screen, so this is an example of Vistra Corp, which was the best performing stock in the S&P 500 last year, I believe, or at least it was for a period. We bought the stock in October 2023. It had about a 260% capital appreciation, and it didn't show up into IGF, which is the largest passive ETF, until October 2024. So they missed out on what was 260% capital appreciation. In addition to that, a lot of these positions tend to exhibit probably higher than normal volatility. So at points we were able to take profits in this position, and we've bought back in when it's been undersold as well. Okay, so why TAMIM Global Listed Infrastructure? Why us, essentially? So probably the first point I should make, which I think is the most salient one, is that for the 8.5 years that we've been managing this portfolio in various different structures, it has consistently outperformed its benchmark, other active managers, and passive indices at a lower volatility. Just looking at some of the specific details. So from inception through to the 31st of May, the strategy has outperformed its benchmark by an average of, by an annualized average of 3.4%, has outperformed large active managers by 4.6%, and the largest passive ETF in the sector by 4.7%. As you can see from the chart on the right at the bottom, during this time frame, we've achieved a significantly higher Sharpe ratio to other active managers in the space. The Sharpe ratio is return per unit of risk. Also, over this time frame, the strategy has outperformed global equities, so the All Country World Index at a lower volatility. Sorry, seem to have lost my place in my slides. So at the end of April 2025, the portfolio had 57 stocks, forecast dividend yield of 3.5%, the PE ratio of 18 times, and a price to book of 3.5%. Annualized volatility for the portfolio stood at 13.8%, which is significantly lower than global equities, 16%, and the passive alternatives in the space around 16.6%. As you can see from this risk and return chart below, we have significantly outperformed the other active and passive funds that are in the space at typically a lower volatility as well. So looking at the performance of the portfolio within a larger multi-asset portfolio, so over the last 8.5 years, or since inception from the strategy, you can see from the chart on the left, the portfolio has essentially sat on the efficient frontier of global indices and other major portfolios. So we've got the 60/40 portfolio there, along with other global indices. And as I mentioned, we well and truly sit on the efficient frontier. So we believe that just looking at a few examples of how the strategy sits in a portfolio, our belief is that listed infrastructure is essential in a multi-asset portfolio, particularly in the current environment where we see high and volatile inflation. And we think that that's an environment that bonds will likely underperform. So this is getting a little X's and O's, so I hope I don't lose anyone, but I'm happy to answer any questions at the end if needed. So what we've done is we've modeled a combination of the strategy mixed with cash, and how it would perform against a bond aggregate. So if we match the volatility of that bond aggregate to the mixture of cash and the portfolio of cash and the strategy, what we see is you generate a additional 5% in annual returns. Putting that multi-asset portfolio into, or putting that cash and strategy portfolio rather into an established multi-asset portfolio structure like the Brown permanent portfolio, which is a quarter cash, a quarter bonds, a quarter gold, and a quarter global equities. And so if we replace that cash and bond component with the mixture of cash and the strategy, what we see is an improved risk-adjusted return, and the chart on the right shows a significant uptick in returns since inception. So the portfolio statistics, I won't deal too deeply into this because I'm more than happy to answer any questions after or offline should anyone want to know anything more. But as mentioned earlier, we have 57 stocks in the portfolio. Currently, our largest geographic exposure is to the US, which makes up about 50% of the portfolio. The second largest geographic exposure and our largest geographic overweight is Japan at 11.3%. And our largest GICS subsector exposure is to electric utilities. I'll briefly touch on our investment process, but if you've heard Robert Swift speak before, you're probably quite well informed of how we manage our process. So firstly, we run a genuine quantamental process. I personally hate the term quantamental, but in layman's terms, what we're using is computer models to accomplish a lot of the really arduous legwork, and then knowledge and experience to form our fundamental view, which then forms the portfolio. I have a colleague that calls this process computer models plus grey hair, and I think that's probably a pretty good way of describing it. It's a very disciplined process where we manage the portfolio to a benchmark, and we track the tracking error risk at between, contain the tracking error risk at between 4 and 5%. 4 and 6%, sorry, 4 and 6%. Just touching on a couple of stock stories of Alpha examples, stuff that's gone very well for us in the past few years. So Sterling Infrastructure is a infrastructure construction company in the States. Um, we had long theorized that the bulk of the near-term benefits from a lot of the federal infrastructure bills, which I had mentioned earlier in the slide, the Inflation Reduction Act and the uh, Inflation Reduction Act and the Infrastructure and Jobs Act, would flow through infrastructure construction companies rather than operators. So we wanted to get exposure to this space within the market. Sterling had scored very well in our quant model, so we entered an active position. The stock has surged very well on significant revenue growth, and it has a continuing backlog, which currently sits at over 2.3 billion. It's now the preferred contractor for hyperscalers when they're building out their e-infrastructure, and we think it's still got plenty of upside and well placed to take advantage in the current market. Right. So Vistra Energy was a stock that I mentioned earlier. I believe it was actually the best performing or close to the best performing stock in the S&P 500 last year. Similarly, on a macro level, we believed that the energy market would reach an inflection point with respect to nuclear power. As energy demands from electrification and an increased penetration from intermittent sources really force the market to revalue nuclear power. This meant that our preference for much of our electric utilities exposure was allocated to independent power producers, of which Vista is one, that have nuclear generation. It's quite an interesting example because it did not score well in our quant model. It had quite a checkered past, and it only emerged from Chapter 11 bankruptcy in 2016. Despite it scoring badly, we overrode the quant model as we saw it as a very compelling growth opportunity and that had some very superior market dynamics. Since we entered into the position, this is to December 31st, 2024, it had done a 207% return. I think that number, if we look at it today, sits at around 280%. So it's continued to do well over the period. And we think that this space in the market still remains compelling. I think I'll finish there and hand over to Darren so he can talk a little bit about the structure of the fund.
Charles, thank you so much. Really appreciate your time this morning, and very interesting to listen to you talk about the infrastructure fund and what actually sits behind the new product strategy. So just going forward to talk about the TAMIM fund and what its key facts or characteristics are, just from an investor's perspective. The usual structure for us is to house it in an unlisted unit trust, which we have done in this instance, which is typically the most common structure utilized in Australia. The minimum investment amount, again, the usual minimums apply here. It's $100,000 as the minimum investment. Applications are on a monthly basis with applications currently open for the 1st of July as of today, and then redemptions monthly with a 30-day notice period. We will be pricing the units on a monthly basis, and we will be looking to distribute annually, although as we get to see the cash flows coming through the portfolio, we can reassess that on a go-forward basis. The management fee structure is 1.25% per annum. And then there is a performance fee, which is 20% of the performance in excess of a hurdle, which is the RBA cash rate plus 2.5% or a minimum of 4%. Please note that you do also add the management fee component to that. So your hurdle there is roughly about 7 to 7.5% at the moment. There are no lockups on this fund, and your buy-sell spread comes in at 25 basis points on either side, which goes to the benefit of the portfolio. Admin and expense recovery fees come in at 35 basis points. So I might head across to the Q&A segment now, and if you do have any questions that you'd like to be asking of myself or Charles for today's webinar, please do so. I note that there are quite a number of questions which have come through already. I'm going to paraphrase some of them because there are some questions that look fairly similar. The one comment I'll just make quickly, Alan, if you're still there, could you please just have a look at the question that you've submitted? I wasn't quite sure what you were talking about on that one. If you could just give me a bit of clarity as to what you're asking, I'll come back to that one and try and get to it at the end of this Q&A session. But Charles, I guess the first one, I suppose, a relatively simple question, and I know you did mention weightings to countries in the portfolio, but if you could just break down what the actual country weighting is across the portfolio. I know you mentioned the US was roughly 50%. What the actual weighting is across the portfolio for its holdings, and also if you could talk to us about why the US comes in so high at a 50% weighting in the portfolio. Charles, you there? You may still be on mute.
Sorry. It's not Robert Swift, but someone else is struggling with technology, it seems. So currently the US is it's actually slightly over 50% exposure. The reason for this is primarily benchmark driven. So if you look at the weightings within the benchmark, the US, I think, sits at somewhere around 56% within the benchmark, and that's a result of the capital appreciation that we've seen in US stocks over the past couple of years. I'll just go through what our weightings are to each country. So secondly, we have Japan, which I mentioned in the slide, which is 11.3%, Canada 8.7%, Europe or continental Europe makes up around, I do have that somewhere. Continental Europe makes up around 15.7%. The UK is around 4%. Australia is quite low at 0.7%. Hong Kong and China combined make up about 2.5%. So as I said, a lot of these are actually benchmark driven, and we're not taking active weights in these specific countries. From a portfolio process perspective, we don't specifically take, I guess, what you'd call top-down macro views. We might have ideas on how the portfolio should look from a risk perspective, but ultimately these views will sit on the margins. So, for example, you might think that the economic picture in Europe looks better than it does in the US at the moment. Now, this won't equate to us selling all US stocks and investing in Europe, but we may take a marginal overweight to what the benchmark position is in Europe. And we may take a marginal underweight to what the benchmark position is in the US. Did that answer the question?
Yeah, no, thanks, Charles. Appreciate it. I guess quite a key question, really, looking at the portfolio. I mean, obviously interesting that we've been running it for such a long period of time offshore and both locally for select managed accounts. When you look at the portfolio on a go-forward basis, maybe looking at 12, 18, 24 months, what do you feel are the key risks that we should be aware of in that portfolio as investors? What are your sort of mitigations around those key risks as well?
Yeah, I think so. because their portfolio invests in the listed space, I guess the general market dynamics or global equity risks tend to flow through to the portfolio itself. Um, so obviously the risks that we see at the moment are just a general rise in volatility. I guess you would say stemming from increased rhetoric out of the White House. Um, my personal belief is that the market will adjust to that increased rhetoric and that volatility may smooth out a little bit. So we're exposed to large volatile events, for instance, in early April during the Liberation Day, but tariff announcement, the market did dip with most of global equities, but also recovered quite quickly. Um, as a rule, infrastructure is probably exposed to less volatility and it's probably less exposed to tariffs, given that it's not because they're physical assets located within countries. They tend not to move uh, terrible much. Obviously, they're exposed to economic activities, but they're not going to have a significant downturn as a result of a massive tariff on a particular country, for instance. Um, in terms of risk mitigation, so we try and build the portfolio, or we look at the stocks we have in the portfolio as a whole. So we're looking at the interactions between stocks, and we're not creating um, a, a portfolio of 50 of our highest conviction infrastructure stocks. We're concerned about how the portfolio moves as a whole, not about how the stocks move individually. So when you do that, you do kind of cover off a lot of the risks that occur in the market. So as I mentioned before, talking about the broad sector diversification, at some point, if electric generation may struggle because of high energy prices, we also have exposure to energy pipelines, which do very well in periods of, of high energy prices. So energy infrastructure, so all pipelines and natural gas plants do very well in periods of high energy prices. And that allows us to kind of move the positioning where we think the portfolio should sit based on the prevailing macro conditions. We don't specifically add hedges within the portfolio. We think we can accomplish much of that just through good portfolio management and allocations to the right areas.
Thanks, Charles. And this is a bit of a more specific question from one of the listeners. Any thoughts around Amazon and their recent data center purchase or investment, we should say, in Australia?
Yeah, so that's an interesting one that's come out in the news in the past couple of days. For those that may have missed it, Anthony Albanese was at the Amazon headquarters in Seattle and announced a $20 billion investment into AI infrastructure into Australia from Amazon, or Amazon Web Services rather. The details are fairly slim at the moment, so I've read a little bit into it, but I don't know a hell of a lot. My main question around it is I'm actually not sure how they're going to power it. There was some indication that Amazon was going to invest in solar generation in Queensland and Victoria. The numbers don't seem to stack up. And in addition to that, I'm assuming it's going to be connected to the grid. So it's going to be drawing 24-hour power from the grid, which is just going to push up energy prices depending how big the data center is. It's if you look at kind of what's already been litigated within data center electricity consumption in the States, the hyperscalers themselves kind of tried this tactic a few years ago where they'd build a data center on the grid. And so when we're adding all this solar generation capacity to meet the needs of our data centers, the problem was that the solar or wind generation capacity was intermittent, and they were pulling effectively grid 24 power 24 hours a day at a pretty sustainable rate or a pretty consistent rate. So now what happens in the States is that if you want to build a data center, you've got to effectively show that you can provide, or you have secured the baseload capacity. So PJM, which is the interconnector on the east coast of the States, kind of acts like our AEMO in Australia. They police this pretty closely, and they won't let the hyperscalers just add quick to put up renewable capacity and then suck out baseload capacity from the grid. So it's an interesting point. Again, I think it's a headline, and I'll wait to see how it actually evolves.
Thanks, Charles. I can see there's just a few questions around not necessarily structure, but the timing of the fund in Australia. So I might just touch on that. And what I will do is any questions that are outstanding, we'll respond to that when we send out the recording of today's presentation. But just in closing, the fund is live as of today. Investments will actually start on 1 July. And if you would like to get details, for example, on the information memorandum or the additional information booklet, on the front page of our website currently, on the Invest Now button, that'll take you through to the information memorandums for this fund plus the other TAMIM funds. So you are able to go on there and invest now. In terms of getting further information or further conversations, Sid, Ben, Michael, and myself are all available over the next couple of weeks to go through any questions you may have on the fund. And certainly we'd be very happy to talk to you. Today's presentation, as I said earlier, was recorded, so we will be looking to get that sent out to all listeners within the next 24 hours. So just to close the presentation today, why infrastructure, why this fund, and why now? Certainly looking at the world and in particular our biggest holdings out of the US, we can see there is a significant requirement for additional infrastructure spend to come through the US over the next 12, 24, even going out to 4 and 5 years at the very minimum. There is a massive requirement for them to step up and build out or renew their infrastructure assets, which will benefit certainly listed infrastructure companies going forward. Certainly looking at portfolios where there is a need for generating equity-like returns, but doing it in a way where the return profile is a lot more smoothed out with a lot less volatility. This is a portfolio that will be able to do that in your overall superannuation fund or retirement fund, wherever you're looking to invest into it from. And I think given the volatility we've seen in the world over the last 5-6 years, that's definitely an advantage to have as an addition to your portfolio. So alongside the strong return profile, that reduction in volatility to us makes a lot of sense. And we look forward to being able to talk further with you about the portfolio over the next few weeks and months. Thank you very much for joining us today. Thank you, Charles, for your time. We enjoyed listening to what you have to say, and we'll speak to you all soon. Thank you.